Hello everyone, and welcome back to lesson 13 in your blockchain basics bootcamp. In today's video, we're going to be talking about decentralized lending, and to fully understand why this is such a powerful concept, we need to start off by analyzing the problems. What are the risks of making loans over the internet? Number 2, what solutions have been developed in the real world? And then number 3, how does blockchain technology allow us to reach in, grab the best solutions from the real world, and make them applicable to the online economy? So let's start off with the problem. The problem here is obvious. We have some money. We want to turn that money into more money, but there's a problem. The other person might default. They might not be able to pay us back. They might commit fraud and have no intention of paying us back. Or they could repay late. We might have to fight to get every single penny out of them. And these problems are compounded when we're talking about making loans on the internet, where we're operating across multiple different legal jurisdictions, some of which might not care if someone defrauds us, right? So a huge risk of lending online. Now, when it comes to traditional banks and financial institutions, they have been making loans for thousands of years, and they've got some systems figured out to protect themselves. They can do credit checks. How likely is someone to repay based on their history? We can aggregate lenders, right? So take money from 100 people and diversify that into 100 loans to break up the risk. We can diversify loans across different industries, sectors, and at the end of the day, we always have the legal system to compel repayment. But one thing that really stands out is the use of collateral. If you do not pay back the bank or the car dealership, they are going to take that car. So as a whole, all of these solutions give us some degree of confidence that we're going to get our money back, but they still have problems. Number one, they take time, they take money, they take resources. If I'm a bank, I don't want to spend lawyer fees taking someone to court to get a car back. I just want my money, because even if I get their car, I'm a bank, not a car dealership. So in an ideal world, we would want a technology that does a couple different things for us. Number one, we want to take the best aspects of traditional lending and make it applicable to online lending. Number 2, we want to improve on the traditional model by cutting out this whole need for arbitration. We want the terms of the contract to automatically be enforced. And the way that we do that is through over-collateralized loans and blockchain lending. So let's go through an example. Let's suppose that someone has a digital asset. It could be Bitcoin, Ethereum, an NFT, fill in the blank. They need some cash. They don't want to sell their assets. They just need some quick cash. Someone else has lots of cash. They want to earn some interest. So what happens is the person with a digital asset, they essentially lock that asset into a smart contract on the blockchain. That is their collateral. The person that is trying to earn some interest, they deposit some kind of fiat cryptocurrency into that protocol, right? So it's a cryptocurrency that's denominated in dollars or euro or something like that. Now, what happens is the person that needed money, they get the money. The person that deposited, again, I'm just going to use the example of US dollars, even though when I say US dollars, keep in your mind, it's a tokenized representation of US dollars. The person that deposited dollars, they're going to get an interest-bearing token that not only represents a claim on their principal, but any accrued interest. The interest automatically builds up on that token. So at any time, if they want their principal and interest payment back, they just redeem that token. The blockchain protocol gives them what they deserve. On the flip side, the person that took out the loan, they just repay the loan and they get their collateral back. There are no lawyers, there's no banks. It's automatically executed by the smart contract, which is really cool. But to see the power of this, I want to show you the safeguards of decentralized lending on the blockchain. So let me go through an example. Let's suppose that I put up $100 of collateral and I take out an $80 loan. So far, so good, right? Now, what we don't want to have happen is me put up $100 of collateral, I take out an $80 loan, and then I just let the interest accrue forever and you never get your money back, right? So what these protocols will do is they will have some kind of a threshold, and I'm just going to make up an example. Let's suppose 95%. So the value of your loan can only be 95% of your collateral before it will automatically start going in there and selling your collateral to pay the lenders. So you put up $100, you start accruing interest, $83, you're still fine. You get to $96. Now, in reality, it would start selling your collateral before you get to $96, but just pretend you somehow accrued $96 of loan plus interest. What is going to happen? Well, it is automatically going to start liquidating and selling off a portion of your collateral to pay down that loan. Because again, the person that lent you money, they want their interest. We're not taking you to court. We're not going through a lengthy procedure. It's automatically going to liquidate that collateral to protect their interests. At the same time, we know cryptocurrency, the value of the underlying collateral can fluctuate wildly. So what we don't want to have happen is you put up $100 collateral, you've got an $80 loan value, and then overnight the price of your collateral drops to $50, and now the person, if you default, they're only going to get half their money back, right? So what will happen is that as the value of your collateral drops, either you will put up more collateral, or again, that will be liquidated as well. And again, this is automatically protecting the lender. So if you're looking at this, you probably have a couple questions. Number one, why would anyone even do this? Why would someone put up more collateral than the value of the loan, right? Well, number one, if I'm a lender, there's a lot of protection for me because I know whatever happens, I'm going to get my money back, right? And I'm going to get it back in a way that doesn't require me to do civil litigation. It's going to be automatic, which is really good for me as a lender. But for you as a borrower, there's also advantages. You can get a loan using your existing assets. If you don't have access to a bank, right, but you have Bitcoin or Ethereum, you can take a loan against your existing asset. You can be your own bank. But still, why would someone put up more than the value of a loan? If I needed a $100 loan, why would I put up $150 in Bitcoin? Why don't I just sell $150 of Bitcoin and get $150? Well, pawn shops all across the country are a great example that sometimes people don't want to sell their assets, right? Maybe I'm trying to avoid capital gains tax, right? Because if I sell, I'm going to get a capital gains tax. Whereas if I take out a loan, I don't. Maybe it's a bear market and I say, you know what, if I sell my asset now, it is so undervalued, I'm going to lose money on it. I know it's going to go up someday. I want to maintain ownership of this asset, but I still need money, right? A loan can help us do that. Maybe I'm just a long-term investor and I need some cash, but again, I don't want to let go of my assets. So the key thing here is that it sounds, when I was first going through this, it took me a long time to understand what is the value of this. The value is that you can get access to the cash you need without being forced to sell your assets, right? Now, obviously, if you don't pay the interest back, it will start being liquidated, but it does offer a unique set of advantages there. But there's also numerous limitations. Number one, if I'm the lender, that continually compounding interest is something that many jurisdictions are still working through how to calculate it, how to report it, right? So depending on what country you live in, there can be some tax considerations there. There can be transaction costs, right? Depending what protocol you're using, what blockchain you're using, the cost to interact with a decentralized protocol can be prohibitive unless you're doing a really large transaction. Again, that depends on the blockchain. There can be surprise liquidations. If the value of your collateral falls because the cryptocurrency market is very volatile, you might find yourself where your loan gets liquidated. And then lastly, because all of this is built on programming, smart contracts, we said no human intervention is necessary. Everything automatically executes. In many circumstances, that's fantastic. However, if there's a problem with that code, if it wasn't properly written, it can be hacked, right? And if it does get hacked, we are exposed to massive risk, and we have no traditional safeguards. There's no FDIC coming to save us, right? There's no federal government insurance, at least in the US, on cryptocurrency. So that's an overview of some of the strengths, the limitations of decentralized lending. And the key point here I want to make is that blockchain technology is not going to completely eliminate any kind of risk. Rather, what it's doing is it's extending these time-tested methods of loan collateralization to an online decentralized lending model. Does it solve everything? Of course not, but it makes an attempt to use working strategies and apply them to an online model while also implementing that automatic enforcement of contracts. So join me in the next lesson as we wrap up the course. We're going to finish off by talking about some of the risks of blockchain in general.